Good morning, it's Jeff Christian. It's CPM Group, 19th of April, about 9:30 in the morning. I wanted to talk today a little bit about the gold and silver short-term outlook. Throw out a line about the premiums on 1,000-ounce silver bars right now. Then I wanted to focus a little bit on the May open interest on the Comex May silver contract and talk about that, because it's a kind of interesting issue. And I'm going to contrast it to April of 2011. April 2011 was a very interesting time with very heavy open interest in the May contract that had to be rolled forward. There's a lot of misunderstanding about what was going on in May. It's the stuff of myths, and it's a good thing to review right now, especially given the high open interest that we're seeing in the May 2022 contract. And as you can see here, 2022 is not 2011. It's a radically different situation. We don't expect the kind of replay that we saw in April of 2011, but we would expect some of the guys who tout silver on the internet and say, you know, the price is going to whatever, they may cue into it over the next couple of weeks. And buyers should be very aware of what's actually going on. And they should look back at 2011 as a pretty good example of what didn't happen and did happen. So that's the story. Short term, these prices are through April 11th. In the intervening week, I guess, we've seen the price of gold shoot up over $2,000. It's come back off. It's about $19.70 right now. Silver has shot up. It's broken over $26, and it's actually trading around $26 as we speak right now, testing that to see if it's a new floor. There are, I think, two really big factors that the precious metals markets are keying into right now. One of them is the war in Ukraine, which is heating up, and the next major battle is starting today as we speak. And I think that that is the overall progress and developments in the war are lending strength to precious metals because of the uncertainties that they create in the world. The other one is inflation. We saw February inflation figures come out, or March inflation figures came out last week, and they were very high. And financial markets and the mainstream media and other people are very much focused on inflation, not focusing very intelligently, but they are focusing on inflation, and inflation is seen as a major financial problem right now. So that's sort of what's going on. Our expectation is that these things will keep the gold and silver prices high and strong for the next several weeks and the next couple months. We do expect prices to subside, but probably not until June or July or August. In the meantime, we think that the war in the Ukraine and inflation concerns, and then other things that will be coming along, will keep investors interested in gold and silver and keep the prices high and volatile for a while. So yesterday, Monday the 18th, we issued new short-term gold and silver trade recommendations to our clients. And basically we said, stay long, expect volatility, expect periods of profit taking like we're seeing today, but basically trade these things from the long side for now, because the probability of higher prices is greater than the probability of sharply lower prices in the near term. And so that's our view. I wanted to mention a little bit about the premiums for 1,000-ounce bars. I was looking at some of the touts on the silver market on the YouTube yesterday, and it's very funny because, you know, there's one guy who's been saying for 2 years now, oh, there's no silver left in the market, but I have some, but I have a very high premium, and you can buy it from me. And my understanding is that he tried to lower his premium somewhat in a tongue-in-cheek way, and I guess he got his tongue stuck or something like that. So now he's touting 1,000-ounce bars, and he's saying, you know, with with silver coins in short supply because of blanking issues and supply issues of blanks, the premiums have gotten very high on silver coins. Maple leaves and eagles in particular are the focus in the market. So maybe you should buy 1,000-ounce bars. And I have a special deal. I think he was saying, I have a special deal, $3.75 over spot for 1,000-ounce bars. And then he said something about charging like $31 or $32 or $33 an ounce for a 1,000-ounce bar. And it's interesting because this was yesterday and the price was about $26. So $3 over spot would have been about $29. And in fact, our clients were buying silver 1,000-ounce bars, or they had access to silver 1,000-ounce bars at $29, not at 31 or 32 or 33. So the silver 1,000-ounce bars obviously is there. You have issues with 1,000-ounce bars as investors that you don't have with coins. One of the things is the large price tag there. They are available, and they are available for less than $30 if you shop wisely. May open interest on the Comex, and that's one of the things I wanted to talk about. We have, as of yesterday, 333 million ounces of May open interest. The total amount of silver registered against Comex positions is 335 million ounces. It kind of sounds scary, but it's not. I'll show you why in a second. And it's very similar to a situation we saw in April of 2011, which I'll talk about after this. Of that 335 million ounces of total Comex reported inventories, 249 are eligible and 86 million ounces are registered. So you have a lot of silver. You have nearly record levels. You have silver that, if you go back to 2011, we had 100 million ounces or so of total inventories on the Comex. We have, 335. We have more than 3 times as much silver in the Comex as we have elsewhere. But the key is not to look at open interest or even May open interest relative to inventories. The key is to look at open interest as rolling forward, and most of that open interest will be resolved by the people who are short the May contract buying back their shorts and selling forward to roll their futures positions forward. Most of them will not stand and deliver because that's not how futures markets work. It's not how the silver and gold markets work. It's not how the wheat market works. It's not how the meat market works. Futures markets don't work that way. And anybody who focuses on that is either doesn't understand that or doesn't want you to understand it. So that's not the key. The key is to look at inventories versus deliveries. So over here on the right-hand side, we have open interest versus the inventories. And you can see, oh, it's a little bit tight there. This is total open interest as opposed to just the May nearby active contract. But the left-hand chart is the one to look at, which is open, it's Comex deliveries versus the inventories. And here you can see the inventories are very high, 335 million ounces. And these are the deliveries, and the deliveries have gotten strong. You saw, the Wall Street Silver Boys in 1 month back in early 2020, I guess, 2021 it was. Actually, this was spike of deliveries was when the world locked down in March and April of 2020. And then this spike here, which is a smaller one, was the Wall Street Silver people. But you can see here that, most of that silver is not, silver futures contracts are not physically delivered. And the relationship between deliveries and inventories, it has grown. So you have a record proportion of deliveries covered by inventories. So it's probably not going to be an issue that people are tight for supplies and that pushes the price up. What will be an issue that could push the price of silver up over the next 2 weeks before the price declines would be buying back those May contracts and selling forward. And the act of rolling forward can sometimes push the price of silver up. It happens while the positions are being rolled forward. Once the positions have rolled forward, the price tends to come back off. So if you see the price of silver rising particularly sharply in the next 2 weeks, it's not that there's this nascent shortage of silver to deliver against those COMEX positions. It's that the shorts are rolling forward. The short-term phenomenon, and once it's done, which would be the end of April, the early part of May, you would expect the price to come off. In addition to that, the price is $26 today. You know, if the price does rise because of congestion in the May contract, we would be looking at $27, $28 an ounce. The possibility of a spike to 29 or maybe even 30 is there, but we're not looking for a spike to 50 or 750 or any of the other numbers you hear on the internet. So it's something to watch out for. It's a nice, interesting thing that you might take a speculative position on. It doesn't necessarily work if you're using physical metals because of the high premiums for physical metals right now. But it is something to pay attention to. If you see it, don't be fooled into thinking that this is the beginning of the end and the world's out of silver. It's a short-time phenomenon related to futures markets rolling forward, which happens across futures markets. In addition to all of the silver in New York and New York area vaults, there's ample silver inventories worldwide. On the left-hand side, you can see the Shanghai futures inventories, well over 60, 70 million ounces, and relatively stable over the last 4 or 5 years. There's additional silver in Chinese vaults that isn't registered with the Shanghai Futures Exchange. And then on the right-hand side, you see the London vaults, which have come down from their peak last year, but they are still very high compared to levels prior to 2017. And again, London only started reporting its inventories in the middle of 2016. So we don't have a lot of historic data, but CPM Group's research over the last several decades suggests that 950 million ounces in July 16, when the London market began reporting inventories, were already very high levels by historical standards. Now, this is from a presentation I made at the old Silver Summit back in October of 2011. And I want to run through some things that I was talking about then, because in April of 2000, let's see, case study. In April of 2011, it was 2011, we were out of the Great Recession. We still had the global financial crisis underway. We had international sovereign debt problems in Europe. And we also had the US Treasury heading toward a downgrading of treasuries for the first time in history, thanks to the inability of Democrats and Republicans to do their jobs in Congress and in the White House. You had a loggerhead there that led to a downgrading of treasuries in August or September of 2011. So it was a nasty time economically and financially, and we were growing out of that. And in that environment, silver prices had actually risen to about $38 at the beginning of April. You can see they went from $38 to 49 something over the course of April. And there were a lot of times, actually, some of the same guys who are talking about $50 and $100 and $500 and $1,500 silver today were talking about it back then. And the price did get to $50. And CPM Group actually issued a sell recommendation when the price was around $48. And what we said was, if you look at what's happening, the price of silver is rising because the May shorts on the COMEX are rolling forward, not because investors are buying a lot of silver. And once the roll is behind us, which will be the end of April, the beginning of May, the price of silver is likely to fall back to $38. We were wrong. It fell down to $33. And it fell there in 5 days. And it fell because the pressure on prices, because of the May roll in Comex positions, was behind us. Nothing nefarious. It's the way futures markets work across futures markets. Let me repeat that. It's the way futures markets work across futures markets. Anybody who tells you it's nefarious is either lying to you or lying to himself. Simple truth. Now, that's what happened in the price. Why did we say that? Here's what happened to silver in April of 2011. At the end of March, the price was $37.89. May Comex open interest at the end of March was 367 million ounces. Silver ETF holdings were only 600 million ounces at the time. Coin premiums were 9.3, 6.5%. Pretty high because you had a lot of demand. As you saw April progress, the price went to $48.58. May Comex open interest fell from 367 million ounces to 7.5 million ounces. That's a reduction of 359.9 million ounces. That means that 359.9 million ounces of silver futures short positions were bought back, mostly rolled forward into the July contract. Silver ETF holdings rose 2 million ounces. Not a lot of silver going on into ETF holdings. Eagle and Maple Leaf premia actually declined. And the purchases of maples and eagles, silver eagles and silver maples in April was very, very low. It was sharply lower than it had been earlier, which actually makes sense because people who were buying silver at $37 or lower in the first quarter said, wow, I'm not going to pay $40 or $48 an ounce plus a premium for silver eagles. I'm going to wait for the price to fall back. Supply and demand, economics 101, higher price, lower demand, higher price, higher supply. Yeah, nothing nefarious there. Just a pathetic joke for anybody who believed that. So then when you saw the price fall by the 6th of May, you saw a further reduction in the May deliveries to May open interest to 3 million ounces. You saw silver ETF holdings sold off after the price had fallen, unfortunately, buy high, sell low. And you saw the premiums jump on coins. Why? Because investors who didn't want to buy at $48 a week ago said, oh, at $35, I'll buy. That's what happened in April of 2011. I don't think it's going to happen in April of 2022, but you will see 333 million ounces of May open interest on the Comex roll forward. The vast majority of it will roll forward. A couple million ounces may stand for delivery. And again, this is not delivery of physical metal. This is delivery of warehouse receipts. You have to pay 100% of the value of the silver held represented by those warehouse receipts, which is why a lot of people don't do this. But you know, much of the silver that is delivered stays in those warehouses and it just changes ownership. So we do think that there'll be some upward pressure on silver prices over the next 2 weeks because of the May roll, not because of the inherent shortage. We do think that intelligent investors may pull back from buying coins and other silver price investment products, waiting for the price to come back off. And we do think that the price will come back off. This is just to finish off the May 2011. This was the Comex open interest in the contract. And you can see, you know, yes, it came down in the first half of April And then you had this massive decline in the last 2 weeks of April. So that by the time you got into May, the open interest was gone. And these are the ETF holdings. Investors were not really buying silver ETFs in April, but they did sell once the price started to fall. Ending up with our silver yearbook on May 10th. It will be the definitive work on silver. Here's last year's version, printed version. We sell it as an ebook, but the last page says if you want to print this book, you can take the PDF to a copy shop. These are the print specs for printing it and perfect binding it. This is the 2021 book. We will be coming out with the 2020 book, 2022 book on May 10th. I think I've been saying May 8th in some venues, and I'm wrong. That's a Sunday, and we don't launch yearbooks on Sundays. We try to launch them on Tuesdays. We came out with our gold yearbook on April 6th. It is available online at our site, and we will be turning our attention to PGM yearbook once we get the silver yearbook behind. We have the silver investment program, and we have a variety of other issues, products and services that we provide people. Feel free to go to our website at cpmgroup.com and explore. There's a lot of free reads there in our market view section. Some of them going way back, a lot of educational stuff. And we'll talk to you toward the end of this week. Take care.